Let's get straight to it. The market, as you see it right now, is essentially lying to you. What looks like stability on the surface, this calm, range-bound action, it's really just masking some significant underlying fragility.
And this really gets to the core identity of the current market. The direction of an asset's price, whether it's up or down, is almost a distraction. The real story, the truth, is in the speed of those moves. That velocity is what tells you everything you need to know about liquidity, about risk, and about stress in the system.
So here's how we're going to break this all down. First, we'll define this fragile macro regime. Then, we'll walk through the real causal chain that's driving prices. After that, we'll do a cross-asset breakdown, look at the mechanics of vol, liquidity, and positioning, and finally, we'll pull it all together into a practical framework for execution.
All right, let's start with Section 1, the fragile macro regime. Before we can analyze anything else, we have to establish the foundational rules of the game we're playing right now. These are the principles that are going to govern everything else we talk about. Our entire analysis really hangs on this three-part definition. First, we're in a supply-sensitive market. That means shocks from energy and commodities have an absolutely outsized impact. Second, it's yield-dominated. The level, and maybe more importantly, the velocity of Treasury yields, that dictates the price of everything else. And third, it's liquidity-fragile. As yields rise, market depth just thins out, which leads to much faster, more aggressive price moves.
So let's be clear. This is not some simple trending risk-on environment. Far from it. The mood right now is cautious. It's all about rotation within this fragile structure we've just laid out. Energy is the primary input, yields are the transmission mechanism, and because of that, capital is being allocated very, very selectively.
Okay, that brings us neatly to our second section, the real causal chain. Now that we've defined the environment, let's get into the specifics of how shocks are actually moving through the system, from one asset class to the next. This right here, this is the causal chain that the market is trading right now, step by step. It all starts with energy. That flows directly into the composition of inflation. That in turn sets the path for yields, which then drives the US dollar. And finally, the combined effect of yields and the dollar, that's what determines what happens to risk assets globally. And this is a critical distinction, the outcome isn't always linear. Take an oil price rise. Is it driven by strong demand? If so, inflation stays sticky, yields stay elevated, and that puts pressure on equities. But what if it's a supply shock? Well, that introduces growth fears, and that can create a totally non-linear response where yields might actually fall if those growth concerns start to dominate the inflation narrative.
And that's really the crucial takeaway here. The chain itself is intact, but the final outcome is absolutely not fixed. It's a function of what the marginal driver is at any given moment. Is it inflation expectations, or is it growth fears?
Okay, so keeping that conditional causal chain in mind, let's move on to Section 3 and start applying this framework to specific assets. Starting with oil. It's firm, and there's a persistent geopolitical premium baked in. But again, the critical distinction for its impact on the rest of the market is its driver. Is it demand-driven? That keeps yields high. Is it a supply shock? That can completely invert the relationship by triggering recession fears.
Now yields, they are, without a doubt, the control center of this entire regime. And this quote says it all. It's not the level, it's the velocity. The absolute level is secondary. A gradual, orderly rise in yields, the system can probably absorb that. But a rapid, high-velocity spike, that's what triggers forced deleveraging. That's what breaks markets. Then we have the US dollar. You can think of it as a global liquidity valve. When the dollar firms up, it tightens financial conditions everywhere, regardless of what any central bank is trying to do. It puts pressure on non-US assets, and it puts a cap on things like commodities and gold.
So what about equities? Well, the situation isn't overtly bearish, but it is structurally very, very fragile. In a regime that's dominated by yields and has fragile liquidity, conviction is just incredibly low. And what does that look like? It looks like choppy price action, failed breakouts, and really sharp reversals, because nobody wants to hold on to directional risk for very long.
Let's look at a couple of alternatives. On one hand, you have gold, which is basically trapped. It gets a bit of a bid from geopolitical risk, but it's capped by high real yields and a strong dollar. Bitcoin, on the other hand, has shown some real resilience. Now, this isn't a signal of broad risk appetite. Instead, it seems to reflect structural flows, things like the ETFs, which tells you there are still pockets of selective liquidity out there.
So if we put this all together, here's a concise risk map of the current landscape. You've got oil, yields, and the dollar, all firm to rising. Equities are fragile with a bias to the downside. Gold is stuck in a range, and Bitcoin is showing some selective resilience. The main takeaway here is that risk is definitely under pressure, but the system feels more unstable than on the brink of an actual collapse.
All right, let's move into our fourth section. We're going to go a level deeper now, beyond just asset prices, and look at the underlying mechanics, volatility, liquidity, and positioning that are really dictating behavior.
A quick pulse check on volatility really confirms our thesis. If you look at equity vol, the VIX, or the fear index, it's elevated, sure, but it's not in panic mode. But then you look at bond volatility and oil volatility, and those remain high and sticky. That tells you that while the surface might seem okay, the underlying fragility is still acute.
And this is a direct consequence of being in a yield-dominated regime. As yields go up, they literally drain liquidity from the system. Market depth gets thinner, and what that means is that smaller and smaller orders can produce faster, more aggressive price moves. For anyone trading this, that means there's just less forgiveness in your execution, and you're going to see wider bid-ask spreads.
Positioning is that final critical variable. Think about it. The same macro conditions can produce completely opposite outcomes depending on how people are positioned. If the market is already defensive and de-risked, a negative catalyst might not do much. But if exposure is still elevated and people are complacent, that same catalyst can trigger a really sharp, disorderly unwind. The market's reaction function is entirely contingent on positioning.
Okay, that brings us to our final section, the trader's reality check. Let's synthesize everything we've talked about into a practical mental model for how to actually navigate this environment.
So what should you be watching right now? Here are the primary variables that matter most. First, the velocity of yields, not just their level. Second, the source of any move in oil. Is it demand or supply? Third, any acceleration in the US dollar. And fourth, those geopolitical wildcards that can just instantly change all the correlations.
And the key takeaway for execution is this. We are in a reaction market, not a prediction market. The regime is just too fragile, and the outcomes are too conditional for some kind of rigid, predictive approach. Success right now requires reacting to how that causal chain is functioning in real time.
And this really brings us to our final point. In this kind of supply-sensitive, yield-dominated, liquidity-fragile regime, velocity tells the truth, and direction often lies. So if you're trading conviction, you're trading fiction. Trying to trade a strong, directional belief is to trade a narrative that just doesn't line up with the market's underlying mechanics. In this environment, that kind of conviction is fiction.